I'm going to start sharing a screen in just a second. The next speaker is Sergio Rossi, who's an economist. Well, I'm going to let Hovard here speak about Sergio, and I'm going to prepare the video. You ready?
I'm ready. Can you spotlight me so I can do this little introduction of Sergio Rossi? He's full professor of economics at the University of Fribourg, Switzerland, and he holds the chair of macroeconomics and monetary economics there. He has published quite some books, one of which I got for a nice price because it's quite an expensive item. He edited with Louis-Philippe Rochon the Encyclopedia of Central Banking. And this seems to me a very authoritative work with a lot of entries that will interest monetary reformers. There are entries on 100% money, credit creation by Richard Werner, and he has more contributions to that. So he is on the forefront at a high level, introducing the right concept about money creation into the academic community. He also participated in the 2018 conference in Switzerland, where many of people that are now with us were there too. Katerina Serifimova was there. Joseph Huber was there, Yuli Korch, Kotlikov was there. So this became a little bit of a stable of people that we could count on to do some presentations. Now, the way we did it with Sergio Rossi was that last week, Stephen and we interviewed him and we taped the interview. And that's what we're going to show you now. The interview actually is almost an hour. So we will only show the first half hour, and then later we will make available the full interview. And that's it for Sergio Rossi.
Professor Rossi, welcome to our interview with AMI on behalf of for the conference, 2021 conference. On the 25th anniversary of the AMI, that's quite a long time already, but it's its 17th conference. Professor Rossi is a professor of macroeconomics in Fribourg in Switzerland, and he has been outspoken and active on behalf of monetary reform in the context of the Swiss referendum. Yuli Korch, also a Swiss, but now an American, I think, organized a conference in 2018 where Professor Rossi also spoke in favor. It was a very interesting conference of people against and in favor of the Swiss referendum. I have been looking through and reading many parts of his encyclopedia. I don't know if it's visible. Encyclopedia of Central Banking with great two-pager entries. And actually the very first entry is on 100% banking, an object that we are very interested in. Today we're going to talk with Dr. Rossi about further insights about about monetary reform, maybe the situation in Switzerland at this moment, and maybe further, thinking about the future about monetary reform, not only at the Swiss level, but at an international level. So besides me is, of course, the director of the AMI, Stephen Walsh, who's leading this conference again. But I invite Dr. Rossi just to start giving a little bit of his background in connection with monetary reform and his deeper thoughts on this subject. And again, thank you very much for joining us, Professor Rossi. You have the floor. Thank you. Dankeschön.
Thank you. Thank you for your introduction and for your invitation. I'm very excited about these issues. I've been investigating monetary economics issues since the late 1980s, when I began studying at university. When I was at high school, I had a professor in economics who was already teaching monetary reforms in light of Bernard Schmitt's work. Bernard Schmitt is a French economist. He died in 2014. He was my doctor father, my PhD supervisor in Fribourg, at University of Fribourg, where I began studying economics in 1987. And then I did my master and then my first PhD in economics under his supervision. At the time, I wrote a PhD dissertation about the future single currency area in Europe, which is called nowadays the Euro area. And I was already at the time against a single currency, but in favor of a common currency, even though these two expressions very often are confused and used as if they were synonymous. Then I got my PhD at Fribourg in 1996. And since at that time, in order to make an academic career, to become a full professor in economics, it was necessary to have a second PhD, or a kind of Habilitationsverfahren in German. Then I decided to go to London, where I met first Lord Desai at the London School of Economics, where I spent 1 year. And then 3 years I spent at University College London under the supervision of Victoria Chick, one of the most prominent post-Keynesian monetary economists. And I did my second PhD at University College London under Vicky Chick's supervision. And the topic was inflation, because inflation very often it is considered as an increase in the price level measured on the goods market only. In my dissertation at the time, I was pointing out that inflation gives rise to an increase in the price level, but not always and everywhere. But inflation is a loss in money's purchasing power, which means that we have to investigate why is this possible that money lose part of its purchasing power. And this is not, as Friedman said, because the central bank increases the money supply beyond any reasonable level. It is because banks, commercial banks, investment banks, and you name it, it is because the banking sector as a whole can create money out of nothing. And this then, I was elaborating on these issues since the early 2000s when I came back to Switzerland. And then I was hired as a professor both at the University of Lugano in the canton of Ticino, where I was born, and at the University of Fribourg. And since 2005, I got a chair at the University of Fribourg, the chair of macroeconomics and monetary economics. And since then, I've been involved also in some political debates, because in 2008, the global financial crisis burst. Since then, the economic issues became a major issue in the media. So I was also involved in some talk shows, some debates at political level, but also with the general public. And nowadays, well, I've been classified as one of the most influential economists in Switzerland in the yearly ranking by the Neue Zürcher Zeitung, a famous newspaper in German-speaking Switzerland. So this is my career, professional at university, but also within the community as large. I would like to contribute to make people understand what is money, how is it possible to enter into a monetary reform that improves the economic situation, the well-being of the people, but also possibly the climate.
Thank you. Yes. And the next question is then, how did you get involved in the issues of monetary theory and monetary reform? Like when did people like maybe Joseph Huber from Germany or Richard Werner, who's also a German, although it sounds very English, his name, when and how did they come on your radar of your investigations?
Well, I've been knowing Richard Werner since I was in the UK during my PhD. We met at some conferences, whereas Huber, I met him much later on when in Switzerland we began discussing about this so-called Vollgeld reform. That this means reforming the way money is issued, and the Vollgeld reform wanted to make sure that only the central bank can issue money out of the blue, out of nothing, whereas if banks want to provide new credit lines, they have first to have some pre-existent savings. So it was in the early 2010, 2012, I guess, if I remember correctly, that I met Joseph Huber. I invited him here in Fribourg to give a conference in front of my students, of my master students. And at the time we were involved in discussing and proposing and elaborating this Folger reform. I was not in the initiative committee, but I was in the committee supporting the initiative, because in my view, it has some merits, but also some defaults, some shortcomings. And this is why I tried to make sure this is going to be a very popular subject, because people believe to consider money as an asset, as a financial asset, as the most liquid financial asset. But most of the time, the laymen and even my colleagues across the university are not in a position to explain what is money objectively. So I think it is an important issue to explain to everybody what is money, where does it come from, how is it possible that money has a positive purchasing power, even though it is purely a book entry in banks' ledgers.
And what was your experience then in the big societal discussion in Switzerland? I guess that started already in 2015 and 16. And then the Monetary Modernisierung, or MOMO, they went on the on a campaign for this referendum. Can you tell a little bit about the content of the referendum and its societal discussion, and how that developed, how it was picked up by the public, by the media, by other experts, especially, of course, the people that would be affected by the reform, the bankers and the central bankers themselves?
It was a hot debate at political level, not so much at the academic level, because at the academic level there was very few discussion. But the reform, the Folger reform, or this modern money idea, is that only the central bank should issue money starting from tabula rasa, from zero. Money is issued via a credit line, and if this credit line is financed with a pre-existing saving, then banks might continue elaborating on this line to provide new credit to firms or to individuals. But if this credit line is not supported by pre-existing savings, only the central bank should do such an operation, because otherwise, so far, banks have been exploiting their capacity to create money out of nothing for what Richard Werner called non-GDP transactions, which means banks do open across the interbank market credit lines. Bank A opens a credit line to Bank B and vice versa, so that both banks might purchase financial assets, increase their own profits, and also the total volume of bank deposits without an increase in total GDP. And this is an inflationary gap. There is too much money chasing too few goods, as Friedman said. But not because the central bank has been over-issuing central bank money. No, this is because banks have been abusing of their capacity to create money out of nothing by not the printing press, but the credit creation mechanism. And in Switzerland, of course, the lobby of the financial place, the bank's lobby is very prominent. Even within the central bank board member, there is an influence from this lobby. There is a kind of revolving door problem also. People in charge of say the CEO of a big bank might eventually become member of the board of the central bank, or vice versa. And so there is a conflict of interest. And this is why also at the central bank level, not just within the banking sector, this Folger reform, or this initiative, has been critically discussed and rejected very strongly, not on conceptual or philosophical grounds, but with respect to ideology, saying that if banks cannot provide credit line out of the blue, and if banks can only provide credit lines up to the amount of their pre-existing savings, then the Swiss economy will reduce its rate of growth. Then we will reduce, instead of increasing, the number of jobs available across the economic system, and eventually everybody will lose more or less in the end. In the academia, the discussion was also like this, but at a very modest level, saying that banks are financial intermediaries. If we cannot give them the possibility to provide loans without having pre-existing deposits, then banks might suffer. Then also firms might not get what they need to invest, and Switzerland will lose its competitiveness. But as you see, these are not really conceptual issues. They are very superficial, surface phenomena. They don't go to the roots of the problem. Namely, they don't know what money is. They still believe, my colleagues across the landscape, and even politicians, even at the central bank level, there is this wrong idea that money has a positive purchasing power, not because there is a gold reserve within the central bank, but because everybody accepts money to reduce transaction costs and to increase the utility or the trade volume of firms. So there is a subjectivist approach to money's purchasing power, or a legal approach. There is a law in Switzerland that obliges us to accept Swiss francs in every payment we enter into. Whereas if there were such a law, there is also the idea that if the state accepts to be paid in Swiss francs for the taxes we have to pay to it, then the Swiss franc circulates across the Swiss economy. There is a subjectivist legal approach instead of an objectivist economic approach, explaining objectively the purchasing power of money, which is the fact that money is issued when banks pay out wages for firms, and therefore wages are both a sum of money units and an income that has been newly created by production.
I see that, Professor Rossi. For England, one of the comments they had of positive money that says, they said England would be hard to go first in trying to start something new. And the central bankers in Switzerland said the same thing, to knock it down. What is your response? And if there was an initiative again, might you do it different?
Yes, thanks for these two questions. They are also crucial as the previous ones. I've heard this critique. If Switzerland were to go in this direction, a full-scale reform, we would be the first country to do this, and we will lose our competitiveness if this experiment doesn't turn to be a good solution to fix some issues. Mm-hmm. I think that we should learn from the fact that the Swiss people rejected the initiative to elaborate on a better initiative, perhaps in a few years, because actually we have noticed in Switzerland as well as at the international level that there are new banking regulations. Swiss banks, especially the so-called too big to fail banks or the systemically relevant banks, they should put aside more liquidity, more own funds in order for the next crisis to have less dramatic effects. But this intervenes at a behavioral level. So banks might decide to increase the volume of lending as they would like to do. They might still maximize their profits out of nothing, because the creation of money starts from zero. And only later on, once they have decided how much credit they will grant, only after they will have to respect some ratio, some liquidity ratio or some capital ratio, where this is intervening at the behavioral level, leaving banks free and bankers free to decide how much credit they will grant, even for what Richard Werner called non-GDP transactions. My argument goes beyond the surface, goes beyond behavior to affect the structure, the monetary structure of the banking sector, saying, well, banks are not just financial intermediaries, they are also monetary intermediaries, which means that banks not only provide credit lines to any bank or non-bank agent, they also create money. As monetary intermediaries, banks are special. James Tobin wrote an article with this title. Are banks special? He asked. Yes, banks are special because only banks can create money. Non-bank financial institution cannot create money. We had this famous expression, the shadow banking system. Once the subprime crisis burst in the United States and then became a global financial crisis, we understood that there are near banks issuing perhaps near money, but this is not correct. Near banks, or non-bank financial institutions to be more precise, are those intermediaries that first have to collect savings to then grant loans. Banks are special because they don't have to respect this constraint. As Schumpeter said, for banks, loans make deposits. The first logical step is for a bank to open a credit line. And Richard Werner was very clear. He did a thought experiment and even a field experiment in Germany he published a paper in 2014. He asked a banker in Germany to explain step by step what he does when the bank is solicited to provide a credit line. And the banker said, we don't look whether or not we have enough own funds. We don't look whether or not we have enough deposits from our clients. We look if the debtor is solvable. We look how much profit we might earn if the client is solvable. And then for us, it is profitable. We give him a credit line, even though in the bank vaults, there are no deposits up to this amount. Mm-hmm. So banks are special, and we need to reform the structural framework in order for banks to provide credit lines. I was against the Folger reform as regards the fact that this reform wanted to forbid banks to provide credit lines beyond the amount of savings they had first to have in their accounts. For non-GDP transactions, I agree with the Folger reform. If a bank opens a credit line to another bank to buy financial assets, well, the bank that opens a credit line should first have enough deposits, either earned or borrowed from elsewhere. But if a bank opens a credit line for GDP transactions, namely to increase production, to increase nominal GDP, namely for a firm to pay out wages, then this should occur starting from scratch, because there is a new bank deposit, but there is also a new income. The debt of the firm is equivalent to the wage earner's income. So at the macroeconomic level, there is enough income to repay all debt, if we abstract from the interest payment for simplicity reasons. But actually, the Folger reform was important for me, and I supported it because first, it pushed not just the laymen, but also politicians to understand what is money, where does it come from, where does it take its purchasing power, and then this implicitly leads us to think or rethink the role of banks as financial, but also as monetary intermediaries. But I was against the solution of the Folger reform, namely because it was too radical. To forbid banks to provide credit lines out of nothing is too radical. It is good to forbid banks to do so for non-GDP transactions, for purely speculative activities, but we don't need, and it is even bad to forbid banks to provide new credit lines out of nothing for GDP transactions, because if we want to increase not just GDP, but also the employment level, we have to allow banks to provide credit lines to firms, even though banks have not enough pre-existing deposits.
I have two questions. One is, could those credit lines come from a central bank representing national money? And second is, the people who deposit, or the companies, the entities that deposit money in commercial banks, could those depositors decide what level of risks they would have their money put to? You know, maybe for credit cards or mortgages or commercial paper. You know, any thoughts about how the future could be and the next initiative? And also, too, it seems like you might be saying banks can create some money as long as if it's GDP oriented. So I'm trying to play between this and what is your thinking on this all?
Yes, thanks a lot also for these two stimulating questions. I start with the second question you raised. I think that it would be a good idea to let depositors decide how much risks should banks take when they use these deposits to refinance some credit lines they have been granting to firms, as regards in particular also the climate risks. In Switzerland, we have since few years, the banking sector in Geneva has established the so-called sustainable finance group. Sustainable finance means that banks in particular should be oriented to support activities, firms' activities that protect the climate and not the opposite, are not damaging the climate. But this is a label. In fact, we could say that depositors should decide not just the risk level they want their deposits to be used by banks, but also the kind of activity. Is it a green or a brown activity, as they are called? Green activities mean they are environment friendly. Brown activity means they damage the environment or the climate or both. So I think the depositors are the owners of this income, and they should be in a position to decide for which purposes and to which risk degree they want this income to be invested by the bank to which they have given their savings. As regards the first question, this is linked to the so-called central bank digital currencies. Cryptocurrencies are in fashion, the Bitcoin, but all other 5 or even more than 5,000 other so-called cryptocurrencies. The most famous one is the Bitcoin, but I always say the Bitcoin or cryptocurrencies are not money. They are a very complex financial asset, perhaps, but they are not money because they are not issued. They are mined. That is, if a set of computers is in a position to solve very complex mathematical calculation problems, then the owners of these computers will obtain a number of Bitcoin, say 25 Bitcoin. There is no work involved and there is no emission of money. And moreover, if I want to buy Bitcoins, I have to go on a web platform or whatsoever. And in fact, I'm starting from a deposit in my own national currency. I have to spend some deposit in Swiss francs to transform this into Bitcoins, as I did when I bought some US dollars starting from Swiss francs. So the origin of my purchasing power is in the form of my national currency. So the Bitcoin is a label put on a bank deposit denominated originally in a national or foreign currency. But the technology, the crypto technology, is interesting. And this might be used by central banks to issue their own crypto. I think the central bank in Sweden has already issued a crypto krone, the Swedish currency unit. And in Switzerland, the Swiss National Bank, the central bank here, has been investigating this issue together with other central banks, also because, well, first, there is the negative interest rate policy, which doesn't work properly. And secondly, there is still the tax evasion issue. If I'm going to buy, say, a car, and I don't want to pay the value-added tax, or the car seller doesn't want to include this into his own declaration to the tax authority, then I'm going to pay cash the car. Perhaps I pay 10,000 Swiss francs the car, 10,000 notes I'm going to deliver cash. So I have no value-added tax to pay. The seller of the car has not to pay any tax on this transaction. And this is the so-called black economy or the shadow economy, or you name it. And the Swiss National Bank and the Swiss Confederation have been investigating whether or not, in order to avoid tax evasion, we should get rid of the 1,000 Swiss franc banknote, which is the highest or the second highest banknote in the world. But the second and most important reason, because in Switzerland we have a very liberal political consensus, so people, if they want to pay taxes, that's fine. But if people want to avoid paying taxes, that's their problem. We don't have to investigate too closer this issue. But the most important issue for a central bank digital currency in Switzerland is that the current negative interest rate policy is not working properly. The Swiss National Bank introduced a minimum exchange rate floor with the euro on the 6th of September 2011 in order for the Swiss franc to limit its appreciation. The Swiss National Bank was willing and ready to intervene, buying any amount of euro in order for the Swiss franc not to appreciate beyond the 1.2 Swiss franc per euro. But then in 2015, the Swiss National Bank observed that this was ineffective and replaced or discontinued this minimum exchange rate Swiss franc euro with a negative interest rate policy. And nowadays we still have this negative interest rate minus 0.75%. This is the policy rate of interest the Swiss National Bank applies to banks in Switzerland. Beyond a given threshold, banks will have to pay this rate of interest on their reserves with the central bank, which is the word upside down. If we have a deposit, we receive an interest normally. We don't pay an interest on our deposits. But we have been observing since January 2015, so close to 7 years now of negative interest rate policy, that this is not actually effective in depreciating the Swiss franc exchange rate. The Swiss franc is still overvalued in some sense. And moreover, the fact that first we had an exchange rate floor, and since 2014-15 we have negative interest rates, we observe that banks have been increasing and even inflating the volume of mortgage lending. The Swiss real estate market is overheated. The Swiss real estate market price level has been increasing much more than the consumer price index, and moreover than available income, then much more than real growth of Swiss economy. So the Swiss National Bank has been inflating indirectly this real estate price level, even though there is not a housing bubble because there is no speculation, in fact. But actually, this might be a major issue that leads the Swiss National Bank to change its policy strategy to issue a central bank digital currency, so that we as depositors, we are going to suffer from this negative interest rate policy in a much effective way. Namely, we are going to spend more instead of keeping our deposits with banks and pay a negative rate of interest or higher fees. We are going to spend or to invest, say, our money not in the real estate market, but on the goods market, if we want to consume more, or buying financial assets to support firms' activities.
Mhm. I'm going to stop it there. I just want to say we continued that conversation, and we did talk more about money creation post monetary reform. In the NEED Act, there's a revolving fund, and there's some decisions. And Rossi later on indicated that for maybe a transition period, there would be some need to continue to support the banks in a similar way that the NEED Act does with the revolving fund, if we find a lot, they need X amount of support. This revolving fund, as John Howell mentioned in his talk, is an issue that needs further conversation, and how it might work in other countries post-monetary reform, because the money is shifting over to government money. How do we work on that transition? And there's more conversation about that with Rossi that you'll be able to get when we should have the videos up within a few weeks. If this video is helpful, please hit the like button, subscribe for new video notifications. Please consider donating at monetary.org/donate. Don't forget to check us out on Twitter at AMI Monetary or on our website